Hey gang, welcome to Time in the Market, the investing channel with a long-term focus, also known as the third best investing show shot in this office, according to my mother. I think it's the only one shot in this office, as far as I know, so I don't know what she's talking about. But hey, top three ain't bad. I'll take it. I also added a camera here. Somebody made a comment down below. Also, make comments down below. I read them around how a camera would add a lot of interactivity to the video. So here you go, buddy. You're welcome. You can also see that I am a nerdy guy now. Clearly adds a lot of credibility to the videos, so I think it's already working. I've also taken a note of some requests that people have made on companies to review because Sonos is one of those companies and I'm going to take a look at them today. As always, guys, this is not financial advice. Please do your own due diligence before making any investment decisions. You will notice that I sometimes look at various cameras. I have three monitors set up here, or at least various angles. I do have three monitors set up here, so I'm not always staring right in front of me where the camera lies. So I'm sorry if I look away from you. So let's jump into Sonos. I'll take a look at what the company does. They make and manufacture audio hardware, what their latest earnings look like, what the financials look like, and see if it's a stock I'm interested in buying. As always, please do your own due diligence, all of that stuff. If you like what you're seeing here, hit the like button, subscribe, stick around. I'm going to make a bunch of these videos on a go forward basis, and forever, and ever, I'm going to be in your life for the rest of your life if you subscribe. So please do so because it's going to be exciting. So Sonos, looking at their earnings from August 9th, 2023, so about a month ago, the stock has done poorly for investors, to say the least. If you were a buyer at IPO, they IPO'd in 2018, so not a ton of history here. IPO'd at 15 bucks, open trading around $20, and have since done very poorly. There were some ups and downs, so maybe you were able to get out at a high point here in the $40 range. They bottomed out right around the pandemic at 750. After that, a good push forward of demand benefited them. They sold a lot of speakers as people were stuck at home, as people wanted a better home theater experience. They do pretty good in the home theater area as well. And then since then, they started falling. Their Q2 earnings was very mediocre to say the least. Q3 wasn't all that great either. So they're down about 29% over the last 5 years, down about 21% year to date, 11% in the last year, 10% in the last 3 years, so on and so forth. Not too great of a result, if I say so myself. So Q3 was okay, 0.4% year over year growth and 23% over Q2, which was a very mediocre quarter, like I said. They narrowed their 2023 guidance down a little bit. So before it was like 8.5 to 10%. Now it's like 9 to 9.5. Same on the EBITDA side. So margin pressure is certainly a thing. They also launched a couple of new products during this quarter, which had pretty good reviews, but seemingly didn't do that well on the sales side. I mean, no growth isn't terrible, but certainly not amazing. And they are certainly seeing continued pressure on the margin side, both on gross and bottom line margins. They did take some steps to right size some of their expenses with a reduction in force, not something you want to see, but certainly something that was needed because their margins are being pressured and their sales are not growing. Potentially, they overhired a bit during the pandemic, like a lot of companies tend to do, and they were just readjusting to the new norm as that demand pull forward that they saw during the pandemic didn't continue and is now starting to slow down, which is reflected in their price. Not a lot of promotional activity in the prior year period, more so in this period as their margins are pressured, some FX tailwinds rather, and then offset a little bit by favorable product mix, meaning they were selling slightly higher revenue products and less component purchases that are generally a less high margin business. You can see some of their investing side, what they're doing. They are an R&D company. The one thing that stands out is some higher legal and transaction costs. One of the major stories around this company right now is they do own a ton of patents and they are embroiled in some legal brouhaha with Google, which is never a good thing to see when you're talking about fighting a massive corporation like that when you're a tiny $1.6 billion corporation. They did get a favorable ruling recently where Google was ordered to pay them about $32 million against $14 million in legal costs. Not a huge gain. But then Google is still continuing their lawsuit, making sure that they'll try not to pay that out if they can. And they're also countersuing for some other issues So there's still more to come on the legal side, but that's an overhang that's going to be around for a bit for Sonos, whether it's positive or negative. More to come on that front. The nice thing about this business, if you look at its history, is that generally this has been a cash generative business from the start. They did had some have some cash flow pressure last year due to some inventory issues, but this year continuing to see positive free cash flow. Last year not too bad either, at least year to date. Um, they're not in any debt issues. They have a positive cash balance. They are buying back shares for the first time in the last 12 months. They have been buying back shares, but most of those shares were offset by higher than average stock-based compensation. So the last year was the actual first time that they reduced their share count with those share repurchases. That seems to be the case on a go-forward basis. They are free cash flow generative, like I said, don't have any debt, probably no plans to take on debt. They do use some of their money from time to time. For example, in 2022, they bought Maked Holdings, which makes transducers. So they're making investments in some technologies, and they make tiny transducers. So maybe what they'll end up doing is make tiny speakers that are a high quality sounding speaker, although at a very small size. So inventory trends somewhat positive, somewhat negative. Inventories in general are lower from Q2, which means they're not holding on to too much stuff, which is a good thing. On the component side, the balance is higher than Q2 and also higher than what they generally want due to a higher lead time. There's lower demand from their retail partners that they're seeing, which means they're holding on to more of their components. They're not making as many goods as they used to simply because of lower demand. So usually what they do is they'll make a speaker, they'll send it off to Best Buy. Best Buy will sell it. Best Buy will hold on to a bunch of these speakers in their inventory, but now they're saying, well, demand is slowing. Stop sending us that many speakers. So now their components are a bit higher. They're not making as many speakers as they normally are, and that may not be a good thing in the long run because once demand picks up again, they'll have to refresh their inventory, etc. And you're seeing that deteriorating demand in their outlook revisions. They're dropping a little bit. They are tightening it up as we are almost in Q4, so the year is almost over. But on the top end, you go from negative 4% growth to negative 5% growth. And on the EBITDA side, you're going from a top end of 168 million to a top end of 158 million. You are getting tighter on the bottom end, so you're not going to shrink as much as you thought going into Q3, but the top end is shrinking and the margins on the top end are shrinking as well. Like I mentioned before, from 8.5 to 10% down to 9.5% on the top end, and that's down from a 12.9% EBITDA margin in 2022. So, losing 300 basis points in 1 year, not a good thing, and that's kind of reflected in the stock price. So Sonos itself, not going to go into huge details, but founded in 2002. They have a ton of patents, grew at a decent clip, not a huge clip, but they are expanding into new categories. They make speakers, they make home theaters, components and architectural. They make weird stuff, like they have a partnership with IKEA where they make a picture frame that has a speaker in it, stuff like that. Their speakers in general are good quality. The one thing you want to know when you're investing in a company that makes hardware is, are they good speakers? Do people like them? Are they going to continue buying them? And I think in general the answer is yes. Another thing to know is that the speaker space, the audio space, is pretty competitive. You probably know of Amazon Echo. Apple is in this space with their HomePod. Google has something going on, and obviously I don't know if Google and Sonos is on the best has the best partnership right now with the Google Assistant, etc. But in general, it's a competitive space, and that's not to mention the higher end space as well. There's probably 10 to 12 other companies that are making good quality speakers out there. If you go onto the audiophile forums, does Sonos get mentioned? Yes. Does Sonos have a good group of people that think their products are great? Yes. But are there a group of people that think that Sonos is a little bit below some of the other high-end speaker makers? Totally. I mean, they don't make the best of the best, but they make good to very good speakers, which is kind of what you want because they are in that middle tier of the pricing space as well. They're not making $4,000 speakers. They're making $500 to $600 speakers, and the speakers are pretty good. The home theater systems are pretty good. I think they actually have the number one market share in the home theater space, which is always nice to see. But this is always going to be a competitive space. The nice thing is that this seems to be an industry-wide wide reduction in demand. It's not just something that's hitting Sonos, because they are maintaining market share and even increasing it in some areas. So that's always good to see. They kind of illustrate their market position here. They're kind of in that premium space, which I don't know if I would put them at the top end of the premium. There's definitely better players out there, more expensive players out there. The one thing that they have against for them is that they are more of an open platform, right? You're not locked into the Apple ecosystem, the Amazon ecosystem, the Google ecosystem. It can work with all of those on its own. Although, like I said, don't know if the Google and Sonos ecosystems are functioning all that well right now. Like I said, they are the leader in the home theater space, the $200 plus home theater space. They are the number 2 player in the $150 plus streaming audio space, both in the United States and EMEA, which is basically the UK and Germany. I think that's the markets they're in. They are mostly a hardware play. They do have some software services. For example, they just launched the Sonos Pro service, which is basically, hey, you have a Sonos speaker. We can give you a streaming service for your business at $35 a month, where you can have licensed music that you can use commercially in your restaurant, store, whatever. It's $35 per month per location. They also have a radio service called Sonos Radio, kind of like a Pandora thing where you pay them. It's free, advertising supported, and then they also have a ad-free $7.99 a month service. But again, this is primarily a hardware play, and sometimes hardware plays can be difficult because margins can be compressed really quickly. Another competitor can come in with a well-priced speaker that is excellent in nature, better than what you have, and you have to keep competing year over year, making sure that your hardware is as good as it gets at a very competitive price point, and that can really make margins difficult. They've done an okay job maintaining margins prior to the pandemic and during the pandemic, but after the pandemic is the question mark. As demand starts to drop off, as discretionary spend starts to drop a little bit, is that going to impact their business for the long term? So far, the answer seems to be yes in the short term, unknown in the long term. They have an open platform. They have a lot of patents, yada, yada, yada. They have this flywheel that they claim that the total addressable market, and you'll see this in a lot of these presentations, is absolutely massive. We only have a tiny portion of it, so we have all of this growth ahead of us. But you only have a tiny portion of it because there's so many players out there, and they're all in different spaces, right? There's the global audio market is huge, but a lot of people just buy $5 headphones and that's it. A lot of people just buy $10 headphones and that's it. A lot of people buy $20 speakers and that's it. Some people buy $5,000 speakers. You're kind of in this middle space. So what's the actual addressable market in that middle space? Are you ever going to address that high-end space, that low-end space? One thing that they've been rumored to announce is some sort of headphone release. That hasn't really been the case. Everybody's waiting for Sonos headphones. Don't know if that's a competitive space either, because you've got so many players. I have a Beats headphone. Apple Air Max is out there. Tons of other players in the headphone space. So it's probably tough to break into. There's been some rumors of a TV that Sonos would release with Sonos speakers, high quality TV sort of thing, but who knows whether or not they'll expand into new product categories like they mentioned here, and what those product categories will be. The latest is that sort of software as a service launch, but there's more to come, I'm sure. Then they're going to expand their geographic reach. They're only in a couple of countries. You can kind of see their core markets here on the bottom. I don't know if they're, you should be able to read them, but they're obviously have a lot of other countries that they could expand to, including, China is not on this list. You're not seeing a lot of Asian countries, probably a lot of growth there, to kind of define their core markets and expand them beyond what we're seeing here. And then other initiatives and things to do. Talking about their, this is sort of the household reach that they can potentially achieve, the number of households that have a speaker and how it's grown, which is very good. One of the things they talk about in this earnings release and kind of their investor pitch is that we have 14 million households that have Sonos products, and only 8.4 million of those households have multiple Sonos products, and on average Those multiple product households have 4.3 products per household. So that means that's a good thing, right? 60% of the households buy more than one Sonos products. If they have a surround sound setup, it's probably a 3 to 4 product setup, which is sort of what it comes down to. But their claim is we have 5.6 million households that only have one product. And if you kind of average out that multi product household, that means that you can add 3.3 additional products to reach that 4.3 multi household product average. And that is essentially $5 billion in incremental revenue. Pretty easy, just sell 3.3 additional products to each of the single product households, and you are doing pretty well. Why haven't they done that before? Why haven't you thought about that before? But it is a good thing to see that so many people who buy a Sonos product buy multiple. You're talking about 60% of the households having multiple products. That is a good thing. And from what I've read, you can kind of go to the Sonos subreddit, do your own research, obviously. People do like the product. People do like their new releases. People are a lifetime customer because they do make a pretty good product that doesn't break down. Main complaints were kind of about, Wi-Fi connectivity being spotty at times, missing Bluetooth, which they fixed in their latest releases, some connectivity issues with external parties, external products, etc. But in general, high quality product that people come back to over and over and over, and that is a good thing from a long term perspective. And you can kind of see their product launch here, etc. Their possible penetration of the 22 billion premium home audio market, the global home audio market, the global audio market, audio content services, and other businesses. And their long term targets, they're currently in that 1.6 billion range with 150 billion of adjusted EBITDA. Their long-term targets, don't know how long-term is, but they're looking to get to 2.5 million. What happens to that 5 billion in incremental revenue, guys? Margins that are going to be slightly higher than they are now, and EBITDA margins in that 15 to maybe 20% range. I think 15% is 375 of 2,500 or so, slightly lower than 20% on the top end. You talk about cash flow conversion in that 50 to 60% range, which is what they've seen in the past, maybe sometimes even higher. So you're talking about a long-term target in that 10% free cash flow margin range, which is seemingly reasonable. Let's look at their financials. Balance sheet, like I said, is pretty pristine. They did spend some money on acquisitions, on buying back shares in recent years. They went from 640 million in cash down to 268 right now. But the nice thing is they have no debt, some capital leases, but not a huge issue. On the cash flow side, they do have pretty high stock-based compensation, which isn't too amazing. We're talking about 75 million against the market cap of 1.6 billion, maybe around 5% in dilution every year. Not great, but they have started buying back shares that kind of wipe that out. I kind of mentioned that 189 million in repurchases versus 40 million in issuances for some of that stock-based compensation. So this is probably the first time where they're wiping out the issuances and the stock-based compensation and actually reducing their share counts, which is a nice thing to see because they are going to need to do that. Otherwise, if you're diluting your shareholders 5% year over year without buying some shares back to account for that dilution, that's not going to be a good thing, especially if you're not growing. Because looking at their estimates, their growth is going to be anemic on a go-forward basis. They saw that push forward of demand, 30% growth in 21, which is where their stock exploded. Really good EBITDA margins, really good free cash flow margins. They were able to get themselves set up with a nice cushion to fund a couple of acquisitions because of that and still sit here in 2023 despite slowing growth, despite some margin pressure, with a very healthy balance sheet, which is a good thing to see because they are going to see some slowdown in their margins, some reductions in their free cash flow margins in the short term. But if the long-term targets turn out to be true, this could very well be a very good buy at these prices. Now, the question mark is going to be how quickly will their margins recover? How slow will their growth be in the next couple of years? And how long will it take to actually reach those 2.5 billion in targets? What is their product pipeline look like? They are going to release new speakers, new home theater versions, new generations of their former products, and they do a pretty good job of iterating and making newer things. But how is that going to impact their margins and growth on a go-forward basis? That is the big unknown. I think their next earnings are going to be very telling because it's their big Holiday quarter, generally, you're talking about a company that has 350 to 400 million in revenue a quarter outside of that holiday quarter, which hits 600 to 700 million. And that is going to be a big question mark. How are their margins going to be guided for in 2024? You'll probably hear more about that in the next earnings. But for now, we can only assume, and I'll do that in my handy dandy spreadsheet here. I've got their buybacks here. You can kind of see that their stock, uh, they've increased the number of shares with stock-based compensation, issuing stocks, etc. It was last year, like I mentioned, was the first time that they actually bought back shares and reduced their share count, which is the good thing. They do not pay dividends, which is good for their cash flow, but eventually I think this is a company that is going to pay a dividend simply because they're going to mature relatively quickly. Don't know if they have any new products ahead, but I think their years of 30% growth are potentially done, and I'm assuming growth is going to be anemic on a go-forward basis, with margins recovering to sort of around where they were prior to the pandemic. That's kind of the long-term goal for me. Even if they don't grow a lot, I want to see margin recovery to get to that 8 to 9% range. I'm assuming 8%. And I'm basically saying that by 2027, they're not going to grow from where they were in 2022. And that's pretty conservative, I think. Pretty conservative. I think your assumptions can certainly be more aggressive, and that would certainly make sense. But for me, I just want to see a recovery on the margin side, which might mean that growth on the top end slows down a little bit. Don't assume any significant product launches if they do launch a headphone business, if they do launch more software as a service businesses that could help spur revenue and potentially improve margins as well. Although new product growths are generally going to be pressuring on the margins initially as they try to build market share. So we'll see how that goes. But for now, I'm assuming standard business going forward. We sort of know what's going to happen in 2023. I'm assuming a negative 5.5% growth and 2% margins, and then 2% growth going forward with margins recovering relatively quickly all the way up to 8% by 2027. So the nice thing about this business is they do generate cash flow. They do not have debt. They are able to sustain themselves through difficult times. If their margins continue to be pressured in the short term, not a huge deal as long as they eventually recover to my target here. If they have to make some investments to get their business back to growth, not a huge deal as long as those margins recover. I'm assuming a long-term free cash flow yield of 5 to 7% or 4 to 7%, mainly in that 5 to 6% range in my analysis here, and kind of putting the scenario weighting in that area. I'm essentially saying that 85% of their valuation is going to be at that 5 to 7% free cash flow yield, which is sort of the yield you would expect for a mature company that's maybe still slightly growing, maybe still slightly improving margins, and potentially having some additional growth down the line as they improve their product offerings and add additional product offerings to their line of products. But in general, this seems realistic to me. This seems very reasonable, very safe and conservative. I'm not making any crazy assumptions. And I'm getting to a price point that's essentially right on top of where it is today. It's crazy that it comes out that way. The stock is trading at 13.23. I get a fair value with all of these assumptions at 13.22 at a 10% target return. Maybe for something like this with the unknowns around their margins, I would want something that has a bit of a margin of safety built in. So it's either a higher target return or building in a 10% margin of safety, which puts me around 11.90 as a buy price. If you want a bit more, at 20%, puts you at 10.58 as a buy price. If you're okay with just taking this as gospel, today's price is pretty fair. And there's certainly significant upside here. I'm assuming growth that is way lower than the estimates. I'm ending up at 1792 in revenue versus 2.1 billion. So 1.8 billion versus 2.1 billion. So I'm 300 million lower than the estimates. My EBITDA is 60 million lower than the estimates because the estimates are kind of assuming that they get back to a 9.5% margin. Let's say that does happen even without any growth. You're talking about a price point that's 20% lower than the fair value today, which is pretty good. If I look at the target return with my assumptions here, I am getting anywhere from an 8 to 16% return if I'm in that 4 to 6% free cash flow yield range. If you are a bit more pessimistic about where the market will price this, Even at 8%, it's still a positive return. Certainly not something you want. You wouldn't want a 2.4% return. But the downside at this price, from a long-term perspective, seems relatively limited to me, which makes this an interesting investment in my mind. The thesis here would be that their margin pressure and their slowing growth is temporary, that there's going to be recovery that starts happening in 24, starts going into 25, 26, 27. And the upside from here would be that the recovery is faster than just 2% growth for those years and margins that recover to a max of 8%. If you think that they can grow faster and you think their margins can get back to 9 to 12% in the long run, then this is a smashing buy at this price point, right? If I put a 12% margin here, this is a price that's going to get you a 10 to 30% return. That should be priced at $20 today. If you think that margins are going to be at 12% in the long run, I'm assuming 25% buyback, so some share count shrinkage due to their free cash flow. That's in addition to their stock-based compensation. So maybe that's a bit optimistic. Maybe it's going to be closer to zero, which reduces the fair value by about 5%. But I'll leave it at 25 because I think there'll be more on this end than this end, where they're actually issuing shares versus buying back shares. As long as they can stay free cash flow positive, I think this business is going to be very healthy for the long term. There's going to be pressure. There's always pressure on the hardware side. They're competing against some mammoth companies in Apple, Google, Amazon that can do a lot of crazy stuff. I could see this as an acquisition target for any of those companies. They do make high quality products. They have a brand name cachet. And if somebody acquires them before this 5-year period is out, before in the next couple of years, I wouldn't be surprised. Can this stock fall lower than it is today? Totally, right? There could be an announcement in the next earnings that their margins are going to be pressured even more into 2024. This is going to be a longer recovery. If margins are pressured, this is going to go down below where it is today. That's really the story here. Where are margins going? And this needs to have margin recovery before the stock price begins to shoot up again. And we'll know more about that in the next earnings call in a few months. I do think this is an interesting buy at today's prices. Will I buy it myself? Probably not, simply because there's so many unknowns, and I don't love the hardware space, just the hardware space as a whole. There's always a lot of competition, always a lot of margin pressures. And as we move into this cycle of the economy, this is the type of business that's going to be punished and has already been punished. And maybe it's already been punished enough. If the stock drops another 10%, I think I would nibble a little bit. At that point, I would be thinking that this has the potential for a 10% plus target return from today's price point, and then I have a little bit of safety from there. And maybe, if the next earnings release shows some recovery on the margin side, I'm sure the stock will react to that on the positive end. But from a long-term perspective, if you're still in this price range at that point, this looks like a very interesting investment. Certainly don't hate it. I would lean towards the like it side versus love it side at today's price point. But I can certainly see why this is an intriguing investment at this price point. Because if you can get to a margin point where a couple of years from now, even if growth is anemic, your margins are back to 12%, you're looking at a $30 to $50 stock in a couple of years, and that's not bad when you're starting at $13. Certainly not bad at all. You're looking at probably, if these are the margins, 17 to 30% returns. That's really, really good on the upside. And on the downside, obviously their margins could be pressured more. You're looking at negative returns to low single digits if margins stay in the mid single digits, or if they're lower, could be worse. But to me, seems like an interesting investment. Let me know what you guys think. As always, leave a comment down below if you agree, if you disagree, if you feel differently about Sonos. I am always eager to hear from you guys and kind of talk about what you think. And if you have any investment ideas for me to look at, let me know. If you agree or disagree with anything I said, if you think I suck, if you enjoy the camera, let me know. Any comments are good comments in my mind. I'm always willing to learn. This is a relatively new channel. I've only started making videos regularly a couple of weeks ago, and they're probably too long because I tend to drone on, and I'll try to work on that. But for now, this is it. As always, guys, I'm not a qualified financial advisor. Please do your own due diligence before making any investment decisions. Thanks for watching. Like, subscribe, all of that stuff. Bye.